Good afternoon, everyone. I'm Maynard Kharkov, and I'm president of COPA and chairman of Freedom Innovations. And it's my great pleasure to welcome you to today's webinar. As you know, COPA is the state equivalent of AOPA in that we advocate for the O&P industry at the state level, while AOPA focuses on issues at the federal level, and the two organizations frequently collaborate on these issues. COPA has a very committed volunteer board, a paid lobbyist, and a professional association management company to help us run the organization. Our primary focus is member education and legislative advocacy. Our current legislative focus is to raise awareness of the O&P profession and the expertise of clinicians compared to D&E providers. And this effort is consistent with national legislation currently introduced in Washington by AOPA that some of you are likely involved with as well. I'd like to emphasize that this is your organization. We work to represent you, and we hope that you are a member now. If not, we hope that you visit the website and join as a member today. So it's my pleasure to introduce our speaker, Barry Smith, CEO of Lloyds Capital. I've had the pleasure of knowing Barry for many years and can attest that he is extremely knowledgeable of activities related to buying and selling patient care facilities, as is his colleague, Jeremy Smith, Esquire. In fact, many years ago, Barry represented the seller of a major knee manufacturer that we acquired during my FlexFoot Oser years, and I can personally attest to his ability to extract maximum value for a business. So gentlemen, thank you for making yourselves available for this webinar. I'll turn the meeting to you now, and then I'll rejoin the conference at the end of your presentation to close out the session. Barry?
Thank you very much, Maynard, and good afternoon, everybody that's on this call. We're going to have about 25 or 30 minutes of slides today. We'll talk about what you need to do to prepare your practice for sale. And we hope to have ample time at the end, probably 10 or 15 minutes to go through Q&A. So I want to urge you, if you have any questions, don't be timid. Other people probably have the same questions. So feel free to send them in to Geneva. And when we're done with our presentation, we'll start to go through the questions. So let's go to the first slide and I'll walk you through it. This first slide is loosely called a shoebox of stuff. The bullet points are as follows: always make a good impression, make the buyer's job easy, answer all their questions, don't tell them how much you want, and this process takes time, typically 6 or 12 months. So now that you know what this slide is all about, I'm going to take the slide down and I'll walk you through each of those topics. Number one, making a good impression. There's that old expression that you only get one chance to make a good first impression. And it's never more true than when you try to sell your business. I recently received the data from a new client. He was going to send me all of his information. It came in a box. It was a big box, a big FedEx box. And it was stuffed with tax returns, financial statements, notes written all over the financial statements, yellow sticky notes all over everything. It was a complete mess. And when I get one of those, it just takes a lot of time to work through it and make sure that it makes sense. You can only imagine what happens if you send, as a seller, your data to a potential buyer and they get it alongside data from maybe 5, 10, or 20 other companies. Your data will end up not getting looked at. It'll go to one side. And the data that comes in clean, that's well organized, will get read first. Empathize with the buyer. They've got a lot of files on their desk, and the key is to make their job as easy as possible. Buyers will also ask you a lot of questions. They'll give you a list of stuff that they want. It's very important that you answer all their questions. Even if the questions don't apply, even if you don't have that stuff, even if you don't keep records that way, just tell them so that your answer is complete, 100%. It all ties out and nothing gets missed. One of the other points on this page is not to tell the buyer how much you want for your business. That may sound counterintuitive. And they may ask you, well, how much do you want for the business? And the answer is always going to have to be, it depends. Are you going to buy assets or are you going to buy stock? Do you want the receivables or not? And before you answer that question, you really need to know what the intent of the buyer is. And ideally, you never want to answer that question, because as soon as you put a number on that question and say that I want $1 million, then you'll never get more than $1 million. Guaranteed. I recently went through this just a few months ago. I had a number in my mind that I thought the business was worth. The client had okayed that number. The buyer asked, and I didn't answer the question. Shortly thereafter, we got an offer that was exactly double what I thought the business was worth. Now, how could that be? Well, the buyer had reasons why they wanted to pay that much. It may have been they wanted to be in that marketplace. They wanted to consolidate offices with the ones that they were buying. Who knows what's in the buyer's mind? But if you tell them now how much you want, you totally foreclose the possibility of getting more. So never disclose that information. And remember that it takes time. I've done deals that took 3 or 4 years to close, and deals that took 3 or 4 months. And typically these days, it's probably 6 to 12 months. So you have to be patient. Why does it take that long? Well, you have to gather all your data. You have to find out who's interested. You have to disseminate information. They have 15 or 20 other deals they're looking at, so they may not get to you for several months. Even after a deal is negotiated, it may take 3 to 6 months to close, to go through all the legal hoops you have to go through. So be patient. I guess I could summarize this slide like this. I once sold a business, I think it was in Oklahoma, and I went there to see the place, and when I walked in, it had, I remember it vividly, orange shag carpet, you know, like the 60s. And the decoration in the waiting room was a fish tank. Only most of the water had evaporated. It was down to about 2 inches, and there was a little fish barely alive in the bottom. And that was what you saw when you walked in. So you want to avoid those kind of fish tank experiences. In terms of data, what data do you need to put together? Well, think about it. A buyer wants to see your financials, your tax returns, employee information, leases for your locations, details on debt. But the most important piece of information that you need to give a buyer is not something you'll have in your files. It's a roadmap to your tax return to show a buyer just how profitable you are, because the tax return undoubtedly will not show how profitable you are. So whereas you spend most of your life trying to avoid paying tax and minimizing your taxable income for tax purposes, now when you're selling, you want to show a buyer just how profitable you are, how much money you're making. And that means that you have to go through that tax return or the financial statements painstakingly, pulling out all of those shareholder expenses to make sure that the buyer understands just how profitable you are. Finally, I would say this regarding selling your business. It's not like selling a house. When you're selling a house, you've got the comps. So your realtor will give you the comps, put a sign in your front lawn, and the process begins. And you know within $50,000 or $100,000 probably how much you're going to sell the business for, because there are 4 or 5 homes nearby that just sold. When you're selling your business, you probably don't have any comps. And if I'm selling a business here in California that's doing $1 million, and I know of a business in Alabama that just sold for $1 million, I'll guarantee you the one in Alabama sold for a lot more than you get in California. Because in Alabama, the wages are less, the rents are less, the cost of doing business is less. And therefore, just because one of your friends has sold his business for $1 million, doesn't mean to say you'll sell your business for the same amount of money, even though your business is the same size measured by sales. It's all about profitability. So profitability is the key. I think at this point, Jeremy, we'll go to the second slide. And this slide talks big picture about valuing the business. And when you talk about valuing a business, you need, first of all, an objective estimate of what that business is worth. If it's close to what your gut feel is, then it's time to move forward. The problem is that oftentimes a seller will have a gut feel as to what the business is worth, a visceral feel, and it may not tie in to what an outside objective estimate is. That's when there has to be a meeting of the minds. There's no point proceeding on a sale if you think it's worth $1 million and your accountant tells you it's worth 400,000, because your expectations are probably unrealistic and you're going to waste a lot of time and get very frustrated. So doing a valuation is the very first thing you have to do to make sure that your business is worth close to what you think it's worth. Also, the third point on this page is that sales has nothing to do with value. We'll talk about that in a second. Values are changing with the passage of time. I would say that from a trend standpoint, valuations are coming down. Also note cash versus a promise to pay. These transactions are rarely cash. Oftentimes seller financing is involved, and you have to evaluate what is that seller financing really worth. $1 million of cash versus $1 million note. Timing is everything. Oftentimes, if the business isn't saleable today, it may be saleable in 6 months. And finally, figuring out profitability, because that in turn dictates value. So if you take that down, Jeremy, I'll talk a little bit about valuation. Obviously, it's the key to getting a deal done. You need to get it done right. Otherwise, if your value is not the same as a buyer, then hopefully you're close. But if you think it's worth $1 million, the buyer thinks it's $500,000, someone's terribly wrong and they both have the same data. So what are the factors then that go into valuation? Here is a brief list. There's probably about 20 factors. The number one factor that dominates the list, head and shoulders above everything else, is profitability. And as I said a moment ago, that if you look at your financial statements and your tax return, you may not see there's a lot of profit because you're not trying to show profit. You have to demonstrate to a buyer where that profit really is, that it exists, and how big the profit is. Unless you can do that, you can't get a sale done. It's the first question a buyer will ask you, and then they'll want you to email them your data that supports that profit level. If you can't do that, then you're off the tracks immediately. Other factors that are by far less important, but they fill out the mosaic of what a buyer is looking for, would be the number of locations you've got, what your balance sheet looks like, whether you have debt. Very important is sales trend. If you've got a business that did 600,000, 700,000, 800,000, $1 million too for the last few years, growing nicely, beautiful. If you had a business that's doing $1 million to 900, 800, 700, 600 for the last year, and now you're thinking of selling, going to be a tough sale. Tied in with that is timing. So when you decide to sell the business, make sure that you know you've got 2 or 3 years left before you exit, because these things take time. Buyers want you to stay. And if you're trending up, they'll want you to stay to keep that trend in place. So sales trend is really critical. Staffing is critical. especially if you're thinking of leaving at the point of sale and you've got two clinicians, one of them's close to retirement, the other one you don't know about. That's what a buyer is going to be focused on. In fact, they'll obsess about it because if the clinicians leave, that creates a problem for the new owner. Competition is important. If you're the only guy in town, great. That's rarely the case. If you're the biggest company in town, that's one issue. If you're a small company, but you've got the capacity to grow and you're aggressive, that's another issue. But the competition is always important. Leases can sometimes control. If you have a great lease that's below market, that's good. If you have a long-term lease that's above market and your business isn't doing well, probably that's not good. Are you going to stay or leave? Finally, what's your compliance like? If your compliance is good, meaning that you may have had some audits, but you've come through them with your skin, unless you've had a lot of ZPIC or other kinds of audits, compliance is key because that buyer is taking over your business, probably assuming some liability for the audit trail. And it's important that the buyer knows that, so you have to disclose that. So let me go back to the first thing I said, profitability. It is the key thing. And if you don't do anything else, you need to sit down with your tax returns and your financial statements to figure out how profitable you are. The buyer is not going to do that for you. If you let them do it for you, guess what? They'll show a lot less profit than you could by yourself. And that determines the purchase price. So now that we've gone through all of those issues that affect the value, what is the valuation numerically going to be? It's going to be a multiple of what your profitability is. That multiple will be anywhere from 3 to 8 times your profitability. So what determines where you land on that scale? Whether you're going to get a multiple of 3 times your profit or a multiple of 8 times your profit. Depends on a lot of things, how big you are, how many locations, what your trend looks like, if you're a $20 million company or a $300,000 company. So generally speaking, the larger and the more profitable get the bigger multiple. The smaller and therefore the less profitable get a smaller multiple. Finally, in terms of valuing the business, there's one issue that's really critical, and that is how the sale is structured and whether it's a sale of stock or a sale of assets. If it's a sale of stock, meaning that you're going to transfer the stock in your corporation, or you're going to transfer the membership interest in your LLC, then you're selling the entity to the buyer. And the buyer therefore acquires everything the entity owns, such as receivables. If, on the other hand, you're selling assets to the buyer and they don't want your contracts, then they're probably not going to acquire your accounts receivable. So I did one deal this morning, it's on my desk, and the receivables are $800,000. So if you're selling stock, the price will reflect the acquisition of the receivables. If you're selling assets, it will reflect the fact that you're probably going to keep the receivables. You can't expect to get paid twice. Okay, so that takes care of those 2 pages. We're going to switch now and talk about legal aspects, and I'm going to turn this over to Jeremy, who is a transactional lawyer who does O&P transactions. If you can believe that's a specialty, it's a specialty. And he'll go through the legal aspects involved in the sale.
Well, thank you for the kind introduction, Barry. Good afternoon, everybody. Thanks for joining us here. I'm going to put up a slide really quickly here.
I'm good.
Just to show you an overview I'm going to cover in a very short amount of time here. As Barry mentioned, I do a lot of O&P deals, and I work in the purchase and sale of businesses extensively. So this is a real quick overview of what you can kind of expect on the legal side. Here's the questions I get asked the most and the issues that come up the most. First of all is, what should this cost? What's it going to cost to hire an attorney to get this done? It's the number one thing people ask me when we start talking, just as Barry indicated, the first thing they ask him is, what is my business worth? So we all understand where you're coming from. Second, only to that is how soon should you hire an attorney? And then what kind of attorney do I need? What are the big legal obstacles that are going to come up in the deal, both in terms of negotiation, the agreements themselves, and how those issues are reflected in these long contracts we end up having to sign. Once we get moving, what does it look like? How long does it take? What should I expect to happen during that process? And then lastly is what can kill the deal. And I'm going to touch on all these really briefly because I only have a few minutes here, but I'll try to fire through them as best I can. So the first question I get asked, as I mentioned, is what should this cost? The answer, just like the valuation, is it really depends. But I am going to give you a range at the end here. It has a lot to do with the size of your company and the legal complexity of that deal and how many other ancillary agreements there are to it. For example, you might have multiple locations with leases. You might have continuing employment agreements. You might have other things that come into play. If, as Barry mentioned, some deals are paid over time, there's notes and security agreements and things that go along with those delayed payments, so that can make it cost more. But I'll give you a range of deals, you know, in the 1 to 2 million range, particularly those below $1 million. You should be able to get that done between $5,000 and $15,000 as a legal expense. It's a pretty broad range, but I'm trying to give you something to walk away with. The most important factor in determining how much this deal is going to cost you plays into the next part, which is when to get your lawyer involved, and particularly what kind of attorney to pick. The answer to when to get an attorney involved is as soon as possible. What we often see is a mentality or a belief that if I'll get the attorney in late in the game because I don't want to spend the money up front, I'll just delay it as long as I can. And what happens then is we inevitably have clients who are playing attorney and doing things that they shouldn't be doing, like signing letters of intent without having an attorney look at them. So the answer is to get a lawyer as soon as possible. And actually, if you delay that process, it ends up costing you more, because one of two reasons. One is you have to then spend money for the attorney to get educated and get caught up on the deal when he wasn't involved in it, when he or she wasn't involved in it. But more importantly is if you've done anything that's signed, or you've done any diligence, or you've disclosed anything, we can't go backwards. So we'll see clients making mistakes and signing documents they shouldn't have signed. And at that point, we have to spend more time and money untangling things and trying to make the deal work when they really, if we had been involved from the beginning, if any attorney had been involved, you would have been in better hands. It would have cost you less. So the concept that it's going to cost you less to wait to hire an attorney is very false. It ends up costing you more, both in terms of money and in opportunity cost, because the biggest thing that people don't understand when they get involved in the sale of their business is how much time and energy it's going to take up. For most of us, or for most of you, it's your baby. It's been your business for perhaps all of your professional life, and the opportunity cost and the energy that gets wrapped up into letting go of that is enormous. So you need help, and asking for help earlier will ultimately cost you less. In terms of choosing the right attorney, again, this is a huge factor in how much this will cost you in terms of fees and time. There's really two criteria I would want you to walk away with. They need to have expertise in two things. One is they need to be used to working with O&P businesses, because there are legal issues that are unique to your space. And secondly is they need to regularly practice or work in the M&A space. And by that, I mean generally in the purchase and sale of businesses. Those two factors you need someone that has experience in both of those, because if you don't, one thing is for certain to happen. Having the wrong attorney who has experience in neither or only one, or not enough, will do damage. And it's just a question of how or what form that damage takes. Attorneys who are not experienced in this space or with the sale of businesses generally will spend time on areas they shouldn't be spending time on and negotiating things that really are of no consequence. And that snowballs. So what ends up happening is you're spending more on your attorney to do work that shouldn't be done. And the deal is taking longer than it should when it really shouldn't. And the other side is getting fatigued. And that's something we can't even really quantify. So making that choice up front will save you an enormous amount of money, but more importantly, time and energy during the process, which is really something we can't even quantify. The top issues that come up as we're doing these deals, as Barry already mentioned, the deal structure is significant in difference in terms of whether they're buying your assets or whether they're taking over that entity, and there are tax consequences that flow from that. And so you rely on your attorney and your tax professionals to help you with that. Sometimes we have agreements, for example, leases or other contracts, which require third parties to consent to a new party on the other side of it. The core of the agreements that make up the legal side of the deal is what we call the representations and warranties. That's where most of the time that a buyer will spend on diligence looking at you. All of these things eventually manifest into this huge section of a purchase agreement called the representations and warranties. And that is where you'll have to say, you know, a whole host of things about your company being true or untrue, most of which you've never really thought of. But that's where the core of the deal comes in. And from that flows what we refer to as indemnification. And that's a reflection of the representations and warranties and what you are responsible for after you sell this business. That's really the core of where the legal stuff happens. And that's where most of the time is spent in terms of the documents and agreements, getting them refined, negotiated, and to a point where we're comfortable with them. And that'll play into the last part of this, which is what can I expect during the deal process? There's really a couple of phases. First would be what we'd call courting, where you have a broker or you don't. You are entertaining some potential buyers, maybe there's only one. And from that will flow perhaps a confidentiality agreement or a non-disclosure agreement. And the first big thing to come out of that might look like a deal is happening would be a term sheet or a letter of intent. And by that time, you've already exchanged some basic financial information. Perhaps you have a valuation done, or you're working with the broker and they're working on that for you. But the letter of intent will set forth the general parameters of the deal. And after that LOI is signed, you'll enter what we call the due diligence period. And that's where the heart of the deal happens. That is the time when they want to look under the hood and understand every single thing about your business. And this is that period can be anywhere. I've seen it as short as 30 days. I've seen it as long as 9 months. But 30 to 90 days for them to get in and really understand everything about your business. And it's a time for, the best advice we can give there is for you to be as honest and as accurate as possible. It is not the time to hide anything. It's to put it all out on the table. And it really goes back to Barry's point about the shoebox of stuff. That diligence period and the ease with which we can handle it is the degree to which you're organized and the degree to which you have everything ready. If one thing kills a deal more than anything, as we're getting to the last part here, it's not having accurate information. It's not being able to respond in good time with what a buyer is looking for. So if one thing kills a deal more than anything, it's a lack of organization or having inaccurate information. Because then they don't know what they're buying and they're concerned. And as soon as a buyer gets a big red flag and they're unsure of what you're giving them, it's really hard to go back from there. But if you're organized, as Barry said, just like looking at or creating the narrative for your tax return, a tax return is one thing, but creating the narrative that actually explains that tax return is the important part. We have to build the narrative for your business. And we do that by being prepared and organized and getting all this information ready beforehand. So we're not only answering a buyer's questions, we're telling them the story we want to tell them. We get to tell the story our way instead of having to respond to emergencies. So the bombs or the red flags in due diligence kill the deal more than anything, and the inability to kill or to provide accurate information. Second only to that would be having the wrong professionals on the deal, people who don't understand this space and know what they're doing. And then, as Barry mentioned, is being unrealistic as to the value of your business, because value is much different in the purchase and sale of businesses space than you might think, and profitability is something that has to be crafted. So it's just having realistic expectations and not trying to over negotiate based on unrealistic expectations. So that's all I have on my slide. I'm open to questions we'll do at the end, but otherwise I'll move on to Barry's next slide and share that here, which I'm trying to do. And here we go. And there we go.
Great. Thank you, Jeremy. It's a little after 1. I'm going to be about 4 minutes with the remaining material. Then we'll have about 10 minutes for Q&A. So let me remind you again, send your questions into Geneva and we'll start those shortly. A lot of people want to know what the state of the market is. If you're thinking of preparing your business for sale and trying to sell it, it always helps to know, well, is there a buyer out there? And the answer is maybe. The market is robust for some companies. If you're a large company, then Otterbach, Oster, and Hanger are all elbowing each other out for the crown jewels for the large company. They'll go down in size to companies as small as 3 or 4 million. But once you're below that level, Hanger probably is the only one of those 3 that's left in the race. And if you're well below $1 million, in the $500,000 range, then you need to probably think about selling to competitors, maybe to employees. Question, do they have enough cash? There are some regional players who may be operating in your state who could buy. And I often run ads in the various magazines in the industry and see who responds. You get all kinds of crackpots responding, but occasionally you get someone who's legitimate who wants to buy a business. So it's a little difficult to say today because I don't know about your business specifically, but if you're thinking of selling, there probably is a buyer. And once I know where you are, how profitable you are, how big you are, all those kinds of things, I can tell you specifically what the odds are of selling the business. So let me share in the next 60 seconds just some final thoughts to underscore some key points. Number 1, timing is everything. And the best time to sell is not when you're absolutely at the top and starting to go down. The best time to sell is when you're on the way up. Make sure that you're the one that develops a list of all of your expenses buried on your tax returns. Don't let the buyer do it for you. What are those expenses? You may have kids on the return and they're at college. You may have your wife on the tax return and she doesn't even know where the building is, but she's on the tax return. I had recently a company that was doing $2 million and their cost of goods historically had been 30%. And I looked at last year and the cost of goods went up all of a sudden to 50%. And so I thought, why? Because that's a $400,000 increase. So there must have been something buried there. So I asked the husband and wife and they said, well, we did buy a building during the year. And I said, yeah, but the building's on the balance sheet. I can see you're depreciating that. And they said, yeah, but we also wrote it off under cost of goods because that reduced our taxable income. So there's a $400,000 very fragile egg sitting in the cost of goods. That's a big adjustment. Never put a price on the business. It just limits your upside. And remember that the buyer for your business may just be a few miles away, probably a competitor, someone that you've fought with difficult times over the years. And that buyer may be very local. Remember that it takes time to sell, so don't wait. And finally, the buyer must be very comfortable with your staffing to make sure that when the business sells, they can maintain and sustain the revenue. I think at this time, we'll open it up to questions and Geneva will go through the questions that have been submitted.
Thanks, Barry. And as a reminder, you can go ahead and submit the questions in the group chat. We do have a question here for clarification. Is it asset sale seller sells the receivable and stock sale seller keeps receivables?
Just the other way around. Stock sale, it goes with the stock. Asset sale, you keep it, usually.
Okay, thank you. And do you have to notify your contractor that you're selling?
Which contractor?
Blue Cross Kaiser of Sale.
Well, most of the insurance contracts that you have will have a clause in there regarding a change of control, which says something to the effect that if you sell your business, there's a new owner, there's a change of control, you must notify Blue Cross, Aetna, Humana, etc. And so if you sell the stock in your corporation, those contracts go to the new owner of the stock. There's been a change of control, notification should go out. Usually it's a notification as a matter of form and the new owner is approved, but there's always a risk.
Yeah, I've just to touch on that. I've never seen it. I've never seen it not approved in this space, but you do have to notify them. Yeah.
Okay, thank you. And what does the broker typically charge? And does the broker do most of it?
I'm sorry, the second part of that was?
Does the broker do most of the work?
Of the work?
Yes.
Yes. The broker typically charges anywhere from, I've done deals for as little as 2% and as much as 5 or 6%. The larger the business, the smaller the commission. It works inversely. Does the broker do most of the work? The broker does most of the work, from gathering data, talking to buyers, valuing the business, negotiating the deal, and then working with the lawyer very carefully to get the transaction closed. And I've done deals that took anywhere from 6 months to 3 or 4 years. That's a lot of work.
Well, I want to chime in just because I'm a little resentful that the broker's saying he does most of the work. No, I'm just kidding, really. But that's an important point, that there's an inverse commission structure based on the size of the business. And on the legal side, most people think it's a much smaller deal, it's going to cost much less. And it actually, much smaller deals can often be more complicated than the bigger ones due to the size of the company being purchased. So anyway.
Thank you both. And I have another question here. What happens to the old tax ID under the seller?
Well, if you sell the entity, like ABC O&P Inc., if you sell that entity, the tax ID number goes with the entity to the new owner. If you're selling assets, then you keep the entity and you keep the tax ID.
Thank you. And what percentage of profitability do you generally see in practices that are smaller?
Well, if the business is like $500,000 in size, you're lucky to have a 10% bottom line. Often it's less than that, or maybe it's 0. If you're doing $1 million, then probably a 10% bottom line. If you're doing $1 to $3 million, a 15% bottom line. Above $3 million, you may be pushing 20%.
But again, it's about crafting what that profitability can look like when you're not there, because it's different. You get a snapshot of profitability when we look at the company, but it's about crafting the story about the things that are going to get pulled out of it. Personal expenses, lots of things we run through our business, salaries, excessive salaries for people who own the business. Once you start being able to craft that story, you might have a much better number, but it's part about building that narrative before you're in front of a buyer.
You know, being very candid, there's one factor we haven't discussed that affects value, and it's relevant for this group, and that's geography. We are in a very high cost of doing business state. Your compensations, your rents, medical insurance, very expensive. So if you've got a small business in a high cost state, it probably isn't worth very much. And when you get to $1 million, $2 million, $3 million, you'll start to show value. So geography, a high cost state like California, New York versus going south to Alabama, Louisiana, Mississippi, there's no comparison. The revenue, the reimbursement's the same, but the cost of doing business here is so high.
Thank you both. And one last question. It says here, tax-wise, is asset sale or stock better?
It's a tough one to answer on this kind of a call. Probably the answer generically is that it's better to sell stock. better to sell the entity rather than selling the assets. But if you're subchapter S, you can sell the assets and come out of it the same way from a tax standpoint. Complicated answer, but that's a short version. If that's the last question, Geneva,
I believe 2 more questions just came in.
can we squeeze them in?
I
Yeah,
believe
absolutely.
we have one question here. Are businesses usually bought by practitioners?
I've seen it done both ways. I have someone right now who's not a practitioner who's buying, but generally speaking, yes, it's another company that wants to buy another office to have 2 dots on the map. So effectively, it's being bought by a practitioner, usually.
And then one last question. How many businesses do you typically see during the year?
Well, actually, I know these numbers because it's important to me. I've looked at 580 businesses in the last 25 years. I've sold 158 of them, and I've valued all of them. So in a typical year, probably 20. It does peak and valley depending on the activity in the marketplace. If that's the end of the questions, I want to thank the association, particularly Maynard, for inviting us, and for Geneva for your help. We appreciate it.
Yeah. Barry, thank you very much. Say just a couple of other questions if you have a moment. Is there a rule of thumb on the multiple of either revenue or earnings that people should be thinking of?
I mentioned earlier on the multiple range is so huge, it's not helpful, but it's anywhere from 3 to 8. Where your particular business stands on that spectrum is to be determined over time.
And has that changed much over the years?
Yes. Over the years, smaller businesses, less than $1 million, the multiple has come down. So for anyone, I see some names on the screen here that have been around 20 or 30 years. You know, in the old days, if someone called me, I would make 3 phone calls to Hanger, Novacare, and RDA, and I'd have offers within a week and we'd close in 30 days. And I knew exactly what the multiple was. These days, it's a lot more tricky. Small businesses often are not profitable, and you really have to massage them to get a decent value.
Well, thank you.
Sure.
Well, I think that, you know, this is a high interest category for many of our members, and as you can tell by the interest across the country by people that you know that do not reside in California. So it's a high interest category, and it will continue to be. For those clinicians who have, well, let me say it this way. Clinicians tend to focus on providing great patient care. And like most of us, don't buy too many businesses throughout their career, maybe never really buy or sell one. But can you speak just for a moment about your experience with, as to why somebody should use brokers or investment bankers to make the transaction successfully?
Yeah, it's very simple. You know, I've sold, as I say, about 158 businesses. I have made a lot of mistakes, and I have cut my teeth on those 158 businesses, especially in the old days. I've learned a lot. It's the school of hard knocks. So if you're going to sell a business and you haven't sold one before, you can certainly try and go ahead and sell it by yourself. But then you have to ask yourself the question, what are the odds if I'm doing this for the first time that I'm going to have the same success as someone who's done it 158 times? Whether you use me or somebody else, doesn't matter. You need someone in your corner that's going to go to bat for you, that's been up to bat before. And as a novice, you'll be eaten alive because the buyers have bought hundreds of businesses. Don't put yourself into that lion's den. It's a big mistake.
Yeah, I completely agree. And do you have a slide that could show Jeremy how to contact Lloyds Capital, or can you give the information to our attendees?
Yes, am I unmuted? I am. I put it in the chat room. It wasn't on the slide deck per se, but I put it in the chat room here, and I'm happy to throw it up. Give me 2 seconds and I'll throw it up on a share in just 1 second here. Anyway, continue on without me. Give me about 10 seconds.
Okay, while you're putting that up, I just want to say thank you to both of you for preparing and presenting the subject today. I know that it's a very large subject, and I know that you guys have played a big role in this for a lot of years, both of you. And I'd just like to thank you on behalf of COPA. I'd like also to thank everybody else that's on the call, particularly our members, for supporting the organization over the years. Once again, encourage you that if you're not already a member, to join. I mentioned that it is a volunteer board organization. However, we do have association management expenses. We do have a paid lobbyist, and we have been very effective in changing reimbursement. And while Jeremy's pulling this up, we did just have success in doing so with a very large managed care organization in Orange County, where one of our members brought to our attention that they were floating contracts for 20% or so below current Medi-Cal rates. And many of you know that Medi-Cal rates are about 1/3 less than Medicaid rates across the country. So when you take, that's about 51% of Medicare. And if you only get 80% of that, your billings are going to be 40% of Medicare, and nobody can operate on that. And that puts a lot of patients, over 13 million Medi-Cal patients, at risk for not getting the appropriate technology or the appropriate care. So it's important that we support these efforts. The organization can show success, demonstrate success, and we need to continue doing so to improve reimbursement and access to care for everyone. So you can see the website for Lloyds Capital. You can see the website and the phone numbers for each, and I would encourage you to contact them should you have the need or perhaps further questions. So with that, I would say thank you very much on behalf of COPA. And again, thanks to you, Barry and Jeremy. And that concludes today's presentation.
Thank you, Maynard.
Thanks, Maynard, for having us.
You're most welcome. Thank you.
Have a great day.